Good afternoon, everybody, and welcome to our webinar here this afternoon, Enhancing Your Cash Flow with the R&D Credit, presented by Tom Mao. He is our resident expert at the R&D tax credit. A lot of you may have listened in on previous webinars of his that talk about this hot topic. So we're back today just to give you a little refresher with the half hour that we have this afternoon. If you have any questions, please drop them in the question panel as we do not monitor the chat box. And if we do not get to your question, please submit it in the survey that will pop up at the end of this webinar today. If you wanted to follow along with Tom as he pages through this presentation here today, in the handouts tab of your GoToWebinar page, you can. And we are not offering CPE today because this is only a 30-minute webinar. And as I mentioned earlier, we do have a survey that does pop up at the end of this webinar. Please take the time to fill that out. Let us know how Tom did. Let us know how you liked the presentation. And any questions, things that we could improve on in the presentations, as well as anything that you want to hear from Tom and our SN team of experts. So without further ado, I'm going to pass it along to Tom.
Well, thank you, Kaylee, and good afternoon, everyone, or good morning, depending upon where you're joining us from today. As Kaylee said, our goal today is just to take a quick 30-minute run through the mechanics of the R&D tax credit, how it applies to architecture and engineering firms. We know a lot of firms have been taking advantage of the credit, especially since the rules changed a couple of years ago, and having some great success with it. But we also know there's a lot of you out there who still haven't jumped into exploring what the credit's all about, and we want to give you some education here today that hopefully will show you that it might work for your firm and can generate some really nice tax savings and some cash back in either the firm or the owner's pockets. So let's go ahead and get started. For those of you that don't know us here at Stanbaugh Ness, we've been around for about 100 plus years. We just had our 100th anniversary a little while back. And for most of that time, we've worked almost primarily in the AE space. We have some clients in some other fields, but about 70% of our work is centered in the AE space. We have folks throughout the U.S., and we have clients throughout the U.S. as well. And we are a value-added reseller of the Deltek Vision software, as well as we have consultants that work with Deltek Ajira. So we think we're pretty well-rounded within the industry, and we're going to be focusing today on exactly how the R&D credit does apply to the industry. My role here at Stanbaugh Ness is the Director of Strategic Tax Advisory Services, which is kind of a long title, which basically means my job is to find and present to you tax planning strategies that you may or may not have looked at in the past and how they can work for you. So with that being said, let's get started. And let's start with just a brief history of the Research and Development Tax Credit. It's been around for a long time. It's been around since 1981. Back in 1981, the Reagan administration introduced the R&D tax credit. But at that point, it was very narrowly applied, and it was supposed to just be a temporary tax incentive to help maybe kickstart the economy, keep some jobs on U.S. soil, and generate some innovation on U.S. soil. And as that law was written back in 1981, it probably would have been very difficult to make a case that your engineering firm or your architectural firm would qualify for the credit. I think the perception many of us might even still have today about the R&D credit goes back to its roots when, it was those proverbial scientists in white lab coats working on, the new miracle drug or maybe the new piece of technology, whatever that was 30 plus years ago. It had to be something, for the most part, new or revolutionary to the market. Well, that temporary provision, I think, could be looked as both a burden and an advantage over the years. The Congress never made the code, or never made the Code Section 41 of the Internal Revenue Code, which governs the R&D credit, a permanent part of the code until 2015. So that means for 34 years, we were subject to Congress renewing the credit every couple of years. They would renew it for a year one time, 2 years, 3 years, and then we had to be sure that they would bring it back. Well, they always did. I think there was 1 year that we didn't have the credit in that whole period. So while there was uncertainty, it also meant that they kept examining the credit. And the good news on that is they continue to expand the application of the credit so that today the standard is new to the company, not new to the market or even the industry. So something you're doing for the first time that maybe your competitor has always been doing will qualify. And we're going to talk about today how what you do every day under these rules is new and may qualify. So in between 1981 and 2015, we had some favorable tax court cases where some AE firms took the credit and were challenged by the IRS and were actually victorious against the IRS. And I'm going to talk about that in a few slides as to what that means. So that was very helpful. But the explosion in the R&D credit really came about with the Protecting Americans from Tax Hike Act, or the PATH Act, of 2015. In 2015, it was another one of those years where the credit had expired. It expired at the end of 2014. We waited patiently all year for Congress to act not only on the R&D credit, but many different tax planning strategies, some that were very common, like the accelerated depreciation methods. And finally, on December 18th, they passed the PATH Act. And it actually brought with us some very nice surprises, quite honestly, as it related to the R&D credit. Finally, the credit was made permanent. We don't have to worry about it expiring. It had some startup entity provisions. So if you are a young entity defined as in business 5 years or less, and you're going through some growing pains, you may not have turned a profit yet. Under these provisions, we can actually use the credit to offset employer payroll taxes. You know, one of those burdens that we certainly run into in our early days. But if you're like most firms and you're well established, the big news was the credit can now be used against the alternative minimum tax. And we could spend a couple hours talking about the alternative minimum tax and we probably still wouldn't understand it. But the fact of the matter is over the past several years, more and more companies and their stockholders became subject to the AMT tax, and the AMT tax precluded use of the R&D tax credit to offset it. Well, that went away beginning 1/1/16, and the definition of smaller, I think, is pretty broad here. Small, in this context, means a firm that generates $50 million or less in gross receipts a year. I'm guessing that's probably a good bit of our audience today. And yeah, to me, that's a pretty big firm, up to $50 million. So all of a sudden, we hit 1/1/16, and this credit became quite accessible and quite powerful. So if you weren't aware of the changes back in 2016, don't despair. Certainly, there still may be an opportunity to go back and capture the savings that could be generated for 2016, for 2017. Even 2015's tax year could still be under statute and could be amended. But remember, for 2015, we have more hurdles to jump through because of that alternative minimum tax. So we usually focus on 2016 and forward. So if you haven't looked at the credit yet, it might even make sense to go back and say, well, geez, what savings could I have generated in 16 and 17, and consider amending tax returns and putting some cash back in your pocket from those years. As we look to the future, and I guess I'm a little contradictory here saying the future is 2018 and beyond, since 2018 is already over, but I'm really talking about the 2018 tax year, which some of you may have already filed your corporate or your partnership tax returns, but you may not have. They may be under extension. But certainly the tax landscape changed significantly again in 2018. I'm sure all of you are aware of the Tax Cuts and Jobs Act that President Trump's administration pushed through in December of 2017, which has really changed what tax returns look like for 2018 and forward. With the big changes being tax rates have been lowered. The corporate rate, a big drop from a maximum of 35% to only 21%. While the top individual rate only dropped 39.6% to 37%, there was a much broadening of the brackets, that more income is taxed at lower rates. And there's also that 20% deduction now available for S corporations and pass-throughs, the qualified business income deduction that you probably have already heard about, or maybe your tax advisors talk to you about. So certainly taxes maybe are going down in total, but it's important to realize that the R&D tax credit is just that. It is a credit. It is not a deduction. And the important note on that is credits offset taxes dollar for dollar, whereas a deduction saves you at the effective tax rate. So if you were a corporation and you had a deduction of $1, that was saving you 35 cents in taxes before. At a 21% rate, it's only saving you 21 cents. But once we calculate your tax, the R&D tax credit will offset that tax dollar for dollar. So in my mind, the credit is even more valuable in this lower tax rate environment, because we can offset even more taxable income and eliminate our tax liability. As I said in my first slide, the PATH Act made the credit permanent. Well, what does permanent mean in tax law? Well, that basically means till Congress or the president decide to change it. Nothing's really ever permanent. It just means it doesn't have an expiration date. So certainly we couldn't have a more volatile political situation than we do today. And who knows what will happen as we move forward. Will President Trump be reelected in 2020 or not? That's anyone's guess. Who will control the House? Who will control the Senate? We obviously just saw some change there in the House. So what does that mean? Will a change of command attack the credit? Well, we don't think so, because since the PATH Act in 2015, there was a bill introduced in the House and a different bill introduced in the Senate, both designed to even enhance the credit further. Now, I will say they haven't passed yet, but the important part about those bills is in each case, they had co-sponsorship of both a Republican and a Democratic representative or senator. And we all know that kind of bipartisanship doesn't happen much today. But if there's one thing it appears Congress agrees on, it is the power of the R&D tax credit. So we don't think it's going anywhere. So we think your investment would be well worth it for many years to come. So with that kind of background, let's start talking about what you're really interested in. How much is this thing worth to me? Well, as a general yardstick or a general benchmark, it's usually a minimum of 5 to 6.5% of something called qualified research expenditures. And I'm going to explain to you what they are. But often that percentage is even higher for a growing firm, a firm whose revenue is on the uptick and whose offsetting payroll burden also may be on the uptick. And again, I'm going to explain the formula to you and why that is. Just repeating some of those prior bullet points, the credit is now permanent. We don't have that alternative minimum tax limitation. We have the payroll tax offset for startups. And if for some reason you still couldn't use that credit in the year generated, we can carry it back a year to recoup taxes from the previous year, and we can carry it over for 20 years. So a very good chance you're going to realize the benefits from this credit. So who qualifies and what qualifies? Well, we really work off of something called the 4-part test. And that is those 4 bullet points you see on your screen. But before we get to that, I want to concentrate on the first sentence there and the underlines. The development of an unfunded, new or improved business component. Well, that sounds like a lot of tax talk or accountant talk, and it sure is. So let me explain what that means. The term unfunded basically means you must be at risk for the activity. And the tax court cases that I referred to have gone ahead for the design world, architects and engineers, and it's defined what that means for us. It basically means, do you have financial risk in the project? And if you have a pure time and materials contract where you are going to be paid for every time entry, every minute that goes in the timesheet, based on this tax court case ruling, that is funded. You're being paid. You are not at risk no matter how much time you put in the job, you're paid for. Well, what we find in the real world today is most of our customers don't give us an open checkbook. So most of the design work we see with the firms we work with, it's either lump sum, it's fixed fee, or even if it is on a time and material basis, it has some sort of a hard cap. Well, if your contracts fit into that category or those categories, or at least the majority of them will, they will qualify for the credit. So when we do a study, the first pass we do is we say, well, tell me about your pure time and material contracts. And we're going to sit them to the side. They're not going to count. But in most firms, we find that that's a very, very small percentage. So once we've then zeroed in on the projects that do qualify, and remember, if it's a lump sum or a fixed fee, and you hit a home run and you have tremendous profit margins on it, it still qualifies because you were at risk that, you may have had some hiccups on that job and had some cost overruns. You're not penalized for being successful. It's purely what do the contract terms look like. And in a research and development tax credit study, we obviously are going to take a look at your contracts and verify that. So once we do that, now we're looking at activities. And the activities have to meet these 4 bullet points here. Well, the first one's kind of a slam dunk. The work has to be technological in nature. It has to be based on the hard sciences. Well, engineering by definition is a hard science, but even for our architectural friends in the audience today, most of what we are doing is too. You're designing structures. You're designing, weight loads for walls, all of that sort of thing. The only thing that doesn't qualify is if you're doing something that's purely of an aesthetic nature, saying, oh, that wall would be better if it was painted blue rather than green, something like that. Or if I'm a landscape architect, my client prefers cherry trees over apple trees. But, and I'm certainly probably going to show my lack of knowledge here, but if that cherry tree has a better root system and prevents drainage better than the apple tree, we can still make a case that that design work is based on the hard sciences. So number one's not really too difficult to get over. The second 2 bullet points really kind of work hand in hand. Involves a process of experimentation to eliminate an uncertainty. Well, you all remember probably science class from high school when we developed a hypothesis and a theory and we proved that. Well, yeah, we could do that, and in some cases we do, but it's really a little bit broader than that. It's really all about you are starting basically with a blank sheet of paper, or in this case, a blank screen, when you start a project. Each project carries a degree of uniqueness, and you use your professional expertise to determine what is the best, in essence, way to attack that. What is the best recipe for accomplishing the goals of my client? Really, I think for most of you, that describes the design phase or the schematic design phase of your projects. That is where you are saying, this project is unlike any, well, I won't say unlike any other one I've done before, but certainly unique from any other one that I've done before. And I'm working through developing the solution, developing my drawings or my game plan for how to carry that out for the client. And what we end up with then, the 4th bullet point, is ultimately a new or improved function, performance, reliability, or quality. Well, I think a lot of people relate this one to say, I have to have a new product. I designed the new iPhone. I designed a new miracle drug. Well, again, this definition is broader. It's really just about something that's new or improved, those words that are in the first line there. And again, our take is that project, every project you do is new. You are not just a manufacturer has an assembly line repeating the manufacture of the same widget. Each project carries a degree of uniqueness. Now, that's not just our opinion. That was the premise of something called the Souter case, the tax court case I referred to earlier, where the IRS attacked the engineer and said, we think what you're doing is quote unquote routine engineering. That's just what you do every day. Souter didn't disagree with that's what they do every day, but they said based on your 4-part definition that's in your code, we follow that to a T, and we believe that that means that our activities qualify. Federal Tax Court agreed, and that certainly was landmark and something we can all rely upon to make sure that our design work does qualify. Again, just to review, what is a business component? It's not just a product. It can be a process, developing software, techniques, formulas, inventions, and certainly we know some of the firms have generated some internal use software. That's a possibility for the credit, but we're really concentrating on number one, the product, which is your design package. So now that we've established that the work qualifies, here's a couple examples, and this is certainly not all inclusive, but a couple of examples of things that would qualify. New or improved designs, testing alternatives, testing alternative materials, new processes and techniques, and I had mentioned software before. And just to reiterate, new to the company, not the industry. The project doesn't even have to be successful. One of my partners likes to say that the R&D credit is a way to get some money back for those projects that don't go quite as well as we had planned. And that concept that every project is unique was at the basis of the Souter case and has that tax court support for it. So what are those qualified research expenditures I referred to earlier, and what data do we need to generate to calculate the credit? Well, they really fall in three buckets. But again, in the AE world, the first one is by and large the most important, and that is the wages, W-2 wages, box 1 of the W-2 for those folks that are involved in the design activity. So how do we get that number? Well, we look at timesheet reports and we say what was charged into that design phase for a sample of projects. We do interviews with the project managers and say, what role did this person play? Were they the actual designer? Were they supervising the designer? Were they performing an administrative function? As long as it's in a qualified activity, meets that 4-bullet test, that time counts. The beauty of your industry over some other industries like manufacturers is you keep timesheets. And as long as those timesheets are accurately generated, that piece is already done for you. So we'll take a sample, we'll look at the percentage of time a person has compared to their total time in the sample, and we'll just extrapolate that out over their wages for the year to generate the bucket of qualifying wages. We can use supplies that are consumed in the process. We usually don't see this being a significant number in the AE world. Certainly a manufacturer who's developing a prototype, the raw materials consumed there could be significant. In the AE world, we might see some 3D modeling in the supplies that are used for that, maybe some reprographic costs. We're certainly going to add them in because they're kind of bonus to the study, but we're really going to focus on wages. And then the third category, what we call contracted research, or by terms that we're more familiar with, subcontractors or subconsultants. We can use 65% of their fees, 65% to kind of equate them to what we'd be paying them if they were our own employees, but we really have to look at the contract there. If the sub is charging us a fixed fee, then it's probably not unfunded for us, it's probably funded. We know exactly what we're paying, and the subcontractor might be able to take the credit for that work they're doing for us. The IRS will look at that one pretty hard, so we're pretty careful before we take anything in that category. If it qualifies and we've looked at the contract, we certainly will. But again, we're really getting our bang for the buck in the wages bucket. So how is this thing calculated? Well, it's calculated based on a moving average, if you will. We take the total cost for the current year that we've identified, and we compare that to a base period of the prior 3 years. So the first year you look at the credit, we're going to have to look at projects for 4 years. And we're going to develop the number of costs in each of those years. The formula says current year expenditures minus 50% of the average for the prior 3 years. So let's put that into numbers. Let's say we have not grown. We're exactly the same for 4 years, and we identified $1 million of qualifying wages and other costs in each of those years. Well, $1 million minus 50% of the average, $500,000, equals $500,000, and the credit is calculated at 14% of that number. So for that firm, that's a credit of $70,000. $70,000 less checks their owners are going to have to write to the IRS. And you can see, looking at that formula, if we are growing, the current year number minus 50% of the average gives you a larger difference and thus a larger credit. So for the growing firm, it really can be beneficial. You might say, well, geez, if that's the case, I'm going to start in 2018 and I didn't have any qualified expenditures in the prior 3 years. I'll really maximize my credit. Well, the IRS is on to that one. If you put a 0 in for the prior year, they give you less of a credit on that. Documentation is really the key here. I mean, it is a recognized tax savings opportunity, but we certainly want to make sure our conclusions are well documented should it ever be challenged, that documentation is going to hold up to any kind of challenge or examination. It should also be noted that 40-plus states also offer a credit of some sort. Most of them are going to walk off of the federal credit, and the federal credit is really where the big bang for the buck is. But certainly, we would always look at the state credit as, some bonus dollars in your pocket as well. So in conclusion, I would again repeat that I think this credit has been much misunderstood. A lot of people in the industry just don't relate that it applies to them, and really underutilized. So we don't want you to miss out on your chance. And to wrap up today's webinar, I just wanted to give you a few examples. I'm going to give you examples all across the board in size and type of firms that we've worked with over the years. And this certainly isn't representative of the whole population. I think we're doing in excess of 70 unique credit studies a year right now, and that number is growing all the time. But starting at the smaller end of our client scale, we work for a small civil engineering firm doing about $2.5 million in revenue. They're doing site work, drainage, design, and such. And the first year they get a credit of $16,000. Well, for an owner generating $2.5 million in revenue, reducing their tax bill by $16,000 was pretty attractive to them. With an architect, just a little bigger, $3 million in revenue, and they were able to generate $30,000 in credits. Moving up, a little bit larger firm. This is actually a construction contractor who has their own designers, engineers on staff. They're doing about $20 million in revenue. They do, as you can see, there are a lot of design of retaining walls. They do caisson and drilling design, and a number of different things. Their credit approached $100,000. And as we get into the even much larger firms, a multidisciplined firm that is right around that magic $50 million mark, a little bit underneath it. So they didn't have to go through those AMT hoops and qualifications. They were able to generate $173,000 in credit. And finally, the largest one we work on, which certainly is over the $50 million, certainly doesn't preclude them from still looking at the credit. They're doing $400 million plus a year in revenue, and their credit was at $1.5 million. I will make one last comment on the alternative minimum tax. So even if you are over $50 million, AMT probably still might come up and hit you in 2016 and 2017. But that's another beauty of the new Tax Act that came in 2018. That while the alternative minimum tax still exists at the individual level, it has been much broadened, and less people are seeing it apply to them. In fact, here we're a good way through our tax filing season here, and I've seen very few, if any, people subject to the AMT this year. So even if you are the bigger firm, I would certainly encourage you to take a look at the credit. So in conclusion, what do we do next? Well, if we've got your attention, please reach out, talk to a specialist, whether that's someone here at Stanbaugh Ness or someone else in another firm, and talk to them about how your activities might qualify. At Stanbaugh Ness, we have a presentation that we tailor to the client and walk through with them, get to know a little bit about their activities. And then the next thing we do is we give them a complimentary assessment. If we can gain just a little bit of information out of your time and billing system, we can give you a pretty good estimate of what your credit might be, and we will also quote you a fixed fee to have the study performed. And certainly if that then makes sense from a return on investment standpoint, we'll obviously go ahead and we'll conduct and perform that study for you, and certainly share that information with your tax preparation firm to make sure we're all on the same page and that you can kind of reap the benefits. So that was a quick 30-minute run through. I think we're pretty much up against our time. I apologize, I won't have time to take questions today, but as Kaylee said, please fill out our survey that you'll get here upon the conclusion. Drop all of your questions in there, and within the next couple of days, I will be sure to get back to you with an answer to those questions and a response. And I'm certainly happy to entertain any calls or any emails that you may have. My contact information is here, and you will be getting a copy of the presentation coming your way. So I thank you for joining us today. I would remind you that a week from today, we will have another webinar that will deal with the provisions of the new Tax Act. If you haven't filed your returns yet, or you just want a review of what maybe you went through this past year, or even starting to plan to take advantage for 2019, please join us same time, 2 o'clock next Thursday, March 28th. That one will be an hour long. And that one, because it's an hour, we will actually offer continuing education credits for that as well. So again, in conclusion, thank you very much. It's been our pleasure. We look forward to hearing from you. Bye now.